What's up everyone, it's Cody here. I'm very excited to finally upload this video to answer the request from one of my subscribers. Because of his smaller investment account size, he would like to know what are some of the best stock to buy now around $50 per share. I think a lot of my viewers will have the same question. So in this video, I'll share with you my step-by-step analysis to these good quality stocks. By the end of the video, you will learn my thought process on why I chose these stocks. So if you want to know, remember to stay until the end. I know some of my viewers will follow my stock picks. Please understand that these are not stock recommendations. Do your own due diligence before you make any investment decision. Also, these are all mega blue chip companies with $1 billion of valuation. So no, the stock price will not be affected if you or me or anyone decide to buy or sell these stocks. It will take millions of Cody to make a dent. And let me check. I currently only have 500 subscribers, so don't forget to smash the like button and subscribe if you like this video. With that being said, let's get right at it. Before I start analyzing the stock, I would like to make sure that we understand the difference between stock price and stock values. Even though I make this video for stocks around $50, this does not mean that these stocks are currently undervalued. Many people might think that a stock with a lower dollar price is undervalued, while another one with a higher price is overvalued. I'll be the first one to admit, I made this assumption when I first started investing 7 years ago. Actually, a stock price says little about a stock's value. Even more important, it says nothing at all whether the stock is headed higher or lower. So what does the stock price tell you? The stock price only represents how much the stock is currently trading at. Let's look at the quick example between Berkshire Hathaway and Microsoft. Berkshire Hathaway stock currently trading at around $256,000. And Microsoft is trading at around $178. The market capitalization, which is the company's value at Berkshire Hathaway, is at $415 billion, where Microsoft is at $1.35 trillion. Even though Berkshire Hathaway has a much higher stock price, Microsoft actually has a higher company valuation than Berkshire Hathaway. The key takeaway is that the stock price only indicates its current value to buyers and sellers. The stock's actual value might be higher or lower than the stock price. So if the stock price is not directly related with the stock value, why do people look for stocks with a lower price to invest in? One of the biggest reasons is because many investors prefer to buy stocks in increments of 100 shares. A share price of more than $50 might turn off the average investor. It requires a cash upfront of at least $5,000 to buy 100 shares. That's a large financial commitment to make to one stock. With all that being said, let's move on to the fun part. Some of my favorite stocks that are around $50. Stock number 1, Kroger. Kroger is an American retail company founded in 1883. It is the United States' largest supermarket by revenue in 2019, the second largest general retailer right behind Walmart. The stock price is currently trading at around $33. The 52-week range is between $20 and $37. Kroger's stock price has been steadily growing until it skyrocketed during 2013 and 2015. The sharp stock price increase was because Kroger bought another big American supermarket chain, Harris Teeter. The consolidation helped Kroger's revenue grow substantially. However, the stock price took a 50% haircut from 2016 to 2017. Stock market is a forward-looking mechanism. Investors are usually looking for growth in the future. Even if the company meets its current revenue and earning expectation, if the company mentions anything about downgrading their own outlook in the future, the stock price will react accordingly. And that's what happened to Kroger. Kroger adjusts its outlook for 2016 and 2017 to be weaker than it generated in 2015. As you may know, I like stocks with a good dividend history. I will get paid regardless of the stock going up or down or going in circles. And a growing dividend payout is also a key attraction for many investors. Kroger has been gradually increasing its dividend non-stop since 2006. Also, during the past 10 years, the average dividend per share growth rate was at 13.4% per year. Currently, the dividend yield is sitting around 2%. Even though 2% might not seem like a lot, the dividend growth rate was averaging 13.4% for the past 10 years. I would consider a good quality stocks with sustainable dividend payout over a struggling company with unreasonable high dividend yield. In terms of PE ratio, Kroger has a PE ratio of 16. Kroger's PE ratio is ranked higher than 65% of the company in the retail industry. Compared with one of its competitor, Whole Food Market, with a PE ratio of 30, Kroger's stock price is considered undervalued. You may never heard of the Kroger before. Other big multinational retail corporations like Walmart and Amazon has taken most of the spotlights. In February 2020, Warren Buffett went grocery shopping, and he ended up spending $500 million buying out 2.3% of ownership in Kroger. His track record certainly makes a strong case for investors to copy. Even with Buffett's success, I wouldn't blindly mimic his every move. Kroger already has a stable consumer demand. Kroger is spending a lot of money building 20 automated warehouses. 3 of them are expected to be operational next year. Therefore, the earnings report will be negatively impacted in the short term. This expansion will allow Kroger to compete with the top online grocery delivery companies. Kroger has also ramped up curbside pickup and home delivery options. After examining the fundamentals of Kroger, I hold on to Kroger because of the steady growth of the company. I know that Kroger will not likely provide me with explosive growth in stock price. The competitive PE ratio and dividend history help with my diversified portfolio. Kroger is considered undervalued to its competitors at the moment. And also Warren Buffett's confidence in the management and the overall health of the company is a huge plus. Now that I share a good quality, boring stock, I know some of you might be looking for more explosive growth stocks. By the way, I have created a private Facebook group for like-minded stock investors. I will be sharing weekly stock market updates and earnings reports I'm watching closely in the upcoming weeks. So if you would like to join the discussion, click on the link in the description after you finish watching this video. The best has yet to be revealed, so keep watching. Here is my stock number 2, Advanced Micro Devices. If you're a serious gamer, a day trader, or a computer expert, you'll be familiar with this company. AMD is an American multinational semiconductor company. AMD's main product includes microprocessors, motherboards, chipsets, and graphic processors, and really any important components in your computer. The stock price is currently trading around $54. The 52-week range is between $26 and $59. The stock price almost doubled within a year, making it the best performing company in the S&P 500 in 2019. If we look at the history of AMD stock price, it has been like a roller coaster ride. The stock was at one point trading as low as $1.8 4 years ago, and now the stock price more than 30x. Around 2010, smartphones became popular. People think that smartphones might replace PC computers. AMD did not have a clear direction in the smartphone or tablet market, and the concern has really caused investors to question AMD. So what happened that caused the stock price to rise 30x from 2015 to 2020? When AMD stock was at all-time low of $1.8 in 2014, the new CEO Lisa Su took over the company. Su understands that the semiconductor industry is inherently risky. Each new product development cycle takes around 3 to 5 years. So AMD must make sure that what they're creating today will be what customers are looking for a few years down the road. When Su took over, some of her biggest decisions were about what not to do. Su decided to focus on things AMD is best at. The companies decided not to pursue building technology for mobile phones or sensors. Instead, the company decided to make a big bet on high-performance computing architecture. The main reason for the surge in AMD stock price is that the company is taking market share from Intel and Nvidia, which are the two leaders in the same industry. Since 2017, Intel has lost 10% of its PC CPU market share to AMD. Also in 2019, both Xbox and PlayStation console announced that they will be powered by AMD graphics and computer chips. AMD has never paid dividends in the company history, so for any dividend investor, please be aware of this. Also, AMD is currently trading at a PE ratio of 128. AMD's two main competitors, Intel has a PE ratio of 11 and Nvidia has a PE ratio of 79. The current PE ratio for AMD is nearly 11 times higher than Intel and almost 2 times higher than Nvidia. This is indicating that AMD is overvalued compared to Intel and Nvidia. When a company is overvalued, it does not mean that the stock price will drop substantially in the short term. Again, the stock price is a forward-looking mechanism. I think AMD has been making the right decision in the past few years. There is still room for the stock to go up, but the stock is becoming more vulnerable for stock price correction. The PE ratio is substantially higher than its competitor. Also, AMD is not paying dividend, so this is a stock that are more speculation. With that being said, I would like to introduce stock number 3, Intel. Intel is one of the biggest AMD competitors. It's currently trading at $61 with a PE ratio of 11. Also, it has a dividend yield of 2.26% with a 10-year dividend growth rate of 7.6% per year. So how do we compare AMD versus Intel? Well, Sue was turning AMD around. Major rival Intel was lagging. Intel struggled to move from a 14nm chip to a smaller yet more powerful 10nm chip. Intel's challenge have allowed AMD to gain market share in key areas. A growing number of companies look to shift their operation to the cloud, and as the 5G technology began to emerge, it's an industry that could present a 20 billion to 30 billion opportunity for semiconductor companies over the next few years. In reality, there's no perfect stock, just like comparing AMD and Intel. Both stocks are global health concerns and recession proof because people use computer regardless. I think AMD is an upcoming strong rival in the semiconductor industry. It could potentially chip away Intel's market share substantially. However, it does not pay any dividend, and the high PE ratio is showing a sign of potential overvaluation. Intel has been lagging in some key areas in the past few years, but Intel has a great history of dominance. It has been increasing its dividend yields with a healthy PE ratio. It will be up to you to decide whether you would like to invest in the rising star or the incumbents. I covered the best stocks to buy in 2020 today. They are traded on the US stock market. If you'd like to learn about my top 3 Canadian stock around $50, I have covered this topic in my most popular video by far on my channel. Check out the link above. Also, if you'd like to learn how to invest like Warren Buffett in 10 minutes, don't forget to download the free ebook in the description. If you like this video, don't forget to destroy the like button, subscribe, and click the notification bell and change it to all so you'll not miss any video. You can also follow me on Instagram for things I don't cover on my YouTube channel. See you next time.